On March 26, 2023, China completed its first LNG transaction with France settled entirely in Chinese yuan. No dollars involved, no SWIFT system. The deal went through China's cross-border interbank payment system, CEPS, and the financial world barely blinked. But here's what makes this interesting. France isn't some small emerging market looking for alternatives. It's the 7th largest economy in the world, a core EU member and a permanent UN Security Council member. When a major Western economy starts settling energy trades outside the dollar system, something fundamental is shifting. This wasn't a symbolic gesture. Total Energies, one of Europe's largest energy companies, executed this transaction as part of regular business operations. The yuan used was offshore yuan, CNH, traded in Hong Kong markets, meaning it bypassed Beijing's strict capital controls while still avoiding the dollar. The mechanics matter because they show this isn't just about China wanting to use its own currency, it's about building parallel infrastructure that works for other countries too. The timing is crucial. This happened 14 months after Western nations froze Russia's dollar reserves following the Ukraine invasion. That freeze demonstrated something many governments had suspected but never seen executed. Dollar assets are not just money, they're leverage. And that leverage can be deployed as a weapon. The Biden administration's Treasury Department has used sanctions more aggressively than any previous administration, targeting not just governments, but individuals, companies, and entire economic sectors across multiple countries. Here's the question that should concern anyone paying attention. If the world's reserve currency can be weaponized this easily, why wouldn't other countries start looking for alternatives? We're not talking about replacing the dollar overnight. We're talking about something more subtle, a gradual building of financial infrastructure that gives countries options they didn't have before. The France-China LNG deal isn't the end of dollar dominance, it's a test case. It proved the infrastructure works. It showed major corporations are willing to use it. And it happened without market disruption or political crisis. That success is what matters most, because now everyone knows it's possible. Let's talk about what China has actually built. CEPS, the cross-border interbank payment system, launched in 2015, but most analysts dismissed it as a regional payment system that would never challenge SWIFT. They were wrong about the scale of ambition. As of January 2024, CEPS connects 1,121 financial institutions across 109 countries and regions. That's not regional, that's global infrastructure. But CEPS is just one piece. China has been building a complete parallel financial ecosystem. The digital yuan, eCNY, processed over $250 billion in transactions during 2023, according to People's Bank of China data. Unlike cryptocurrencies, this is a central bank digital currency with full state backing. It's programmable, traceable, and can operate without traditional banking infrastructure. That last part matters enormously for developing countries with limited banking penetration. Then there's the currency swap agreements. China now has bilateral currency swap lines with over 40 central banks, totaling roughly $550 billion. These agreements allow countries to trade directly in yuan without going through dollars first. Russia, Brazil, Argentina, Pakistan, UAE, Saudi Arabia. The list keeps growing. Each agreement isn't huge individually, but collectively, they create a network effect. The more countries can access yuan liquidity directly, the less they need dollar reserves. The Shanghai Petroleum and Natural Gas Exchange launched yuan-denominated oil futures contracts in 2018. Initial volumes were modest. By 2023, these contracts were trading roughly 250,000 lots daily. Still small compared to Brent or WTI, but growing steadily. Saudi Arabia announced in 2023 it would accept yuan for oil sales to China. That's not symbolic. China is the world's largest crude oil importer. If even 20% of Chinese oil imports shift to yuan settlement, that's roughly $100 billion annually moving outside the petrodollar system. None of these systems individually replaces the dollar, but together they create something new. Optionality. Countries can now choose. They can settle some trades in dollars, some in yuan, some in their own currencies through swap lines. That choice itself changes the dynamic. The dollar's dominance has always rested on necessity, not just preference. When necessity becomes optional, everything shifts. February 2022 marked a turning point most economists still haven't fully processed. When Western nations froze approximately $300 billion in Russian central bank reserves, they didn't just punish Russia. They sent a signal to every other country holding dollar assets. Your reserves aren't really yours. They're conditional, and the conditions can change based on political decisions made in Washington, Brussels, or London. This wasn't the first time sanctions were used as economic warfare, but it was the most comprehensive deployment against a major economy integrated into global finance. Russia was cut off from SWIFT, its banks isolated, its companies unable to access international capital markets. The speed and coordination were unprecedented. But here's what the architects of these sanctions missed. The targets weren't the only ones watching. Central banks worldwide began quietly reassessing their reserve holdings. The IMF's COFR data shows something subtle but significant. In Q4 2023, the dollar's share of global allocated reserves dropped to 58.4%, down from 71% in 1999. That's a long-term trend, but it accelerated after the Russian freeze. Where's that money going? About 30% went to gold, which central banks purchased at record levels in 2022 and 2023. Another significant portion moved into yuan assets, which now represent about 2.7% of global reserves, up from virtually zero a decade ago. But the bigger shift isn't just what central banks hold, it's how they think about reserves. The traditional model said you hold dollars because they're liquid, stable, and universally accepted. The new calculation adds another variable: political risk. If you're a country that might someday find itself at odds with US foreign policy, holding large dollar reserves creates vulnerability. You're essentially giving a potential adversary control over your national savings. China obviously learned this lesson, but so did Saudi Arabia, UAE, Brazil, India, and dozens of others. These aren't anti-American regimes looking to build an alternative bloc. They're pragmatic governments trying to reduce a specific type of risk that they now know is real. The Russia sanctions proved that financial infrastructure is geopolitical infrastructure, and countries across the political spectrum took note. The Belt and Road Initiative, BRI, was announced in 2013 as an infrastructure development project. Most Western analysis focused on the geopolitical implications: China building influence through ports, railways, and roads across Asia, Africa, and parts of Europe. But there was always a financial layer that received less attention. Infrastructure contracts denominated in yuan, development loans issued in yuan, Chinese construction companies paying local workers, and suppliers in yuan or local currencies purchased with yuan. By the end of 2023, BRI had engaged with approximately 150 countries, representing roughly 2/3 of the global population. The total committed investment is difficult to calculate precisely. Estimates range from 1 trillion to 4 trillion, depending on what you count. But the financial mechanics matter more than the total. When China builds a port in Pakistan or a railway in Kenya, those projects create yuan-denominated debt. They also create ongoing trade relationships where yuan settlement becomes the path of least resistance. Take the Jakarta-Bandung high-speed railway in Indonesia, completed in 2023. The $7.3 billion project was financed primarily through loans from Chinese state banks, denominated in yuan. Indonesian state railway companies now have yuan debt. They'll need yuan to service that debt. The logical way to acquire yuan is through trade with China. Suddenly, a segment of Indonesian commerce has a structural reason to operate outside dollar markets. This pattern repeats across dozens of countries: Sri Lanka's Hambantota Port, Malaysia's East Coast Rail Link, Serbia's Budapest-Belgrade Railway. Each project creates financial linkages that make yuan usage more practical. It's not that these countries are abandoning dollars entirely. It's that they now have parallel systems where yuan settlement makes economic sense for specific transactions. The genius of this approach is its gradualism. There's no dramatic announcement, no challenge to dollar hegemony, no financial crisis. Just infrastructure projects that happen to create lasting financial relationships denominated in yuan. Over time, these relationships accumulate, they create networks, and networks create their own momentum. Countries that might never have considered yuan settlement 10 years ago now have practical reasons to maintain yuan liquidity. Here's an uncomfortable truth for US policymakers. Monetary policy designed for a domestic economy looks different from monetary policy designed to maintain a global reserve currency. The Federal Reserve faces a choice that's becoming harder to reconcile. In 2022 and 2023, the Fed raised interest rates aggressively to combat domestic inflation, the fastest rate hiking cycle in 40 years. That was the right decision for the US economy. But it created havoc globally. Higher US interest rates strengthen the dollar. A stronger dollar makes dollar-denominated debt more expensive for everyone else. Emerging markets that borrowed in dollars suddenly faced a crisis. Their debt burdens increased, not because they borrowed more, but because the currency they owe appreciated. Egypt, Pakistan, Argentina, Turkey. Dozens of countries found themselves squeezed. The IMF approved a record $140 billion in new lending programs in 2022 alone, primarily to help countries manage dollar debt stress. This creates a paradox. The Fed's mandate is domestic, maximum employment and stable prices in the United States. But when your currency is the world's reserve, your domestic policy decisions have global consequences. And increasingly, those global consequences generate resentment. Countries start asking, why should our economy suffer because American consumers bought too much during the pandemic? China has positioned the yuan as a solution to exactly this problem. The People's Bank of China doesn't target a domestic inflation rate the way the Fed does. It manages the yuan for stability and gradual appreciation, with capital controls preventing the wild swings that characterize dollar markets. For countries tired of boom-bust cycles driven by Fed policy decisions, that stability looks attractive. There's also a mathematical reality the Fed can't escape. The US runs persistent trade deficits, roughly $1 trillion annually. Those deficits mean dollars flow outward. For decades, those dollars recycled back into US Treasury securities, funding US government debt at low rates. But as countries diversify reserves, that recycling becomes less automatic. If foreign central banks hold fewer treasuries, the US government either needs to find other buyers or accept higher borrowing costs. Neither option is particularly attractive to Washington, but the choice might not be theirs to make. For 50 years, the petrodollar system formed the bedrock of dollar dominance. Saudi Arabia and other Gulf producers sold oil in dollars, invested those dollars in US assets, and this arrangement guaranteed dollar demand regardless of other economic factors. But something fundamental changed in 2023. Saudi Arabia let its petrodollar agreement with the US expire without renewal. The mainstream press barely covered it, perhaps because the implications were uncomfortable. The Saudis didn't announce they'd stop accepting dollars. They announced they'd accept other currencies too. That distinction matters. Saudi Aramco, the state oil company, confirmed it would settle contracts in yuan, euros, yen, or local currencies through bilateral agreements. The first major yuan settled oil sale to China happened later that year. The volumes were modest, probably under 10% of total Chinese crude imports from Saudi Arabia, but the precedent was established. The UAE followed suit. Abu Dhabi National Oil Company started accepting yuan for Chinese sales. The Abu Dhabi Global Market, the Emirates' financial free zone, began offering yuan-denominated financial products. ADGM became a clearing hub for offshore yuan in the Middle East. None of this required breaking with Washington. The Gulf states maintained strong security relationships with the United States. But economically, they're hedging. Why would the Gulf states risk upsetting their traditional security partner? Look at the trade flows. China is now the largest oil importer from the Gulf, larger than the US, Europe, or Japan individually. Chinese demand for Gulf crude will only grow as its economy expands. Meanwhile, the US is increasingly energy independent thanks to shale production. The asymmetry is obvious. Gulf producers need Chinese demand more than they need American demand. There's also the political dimension. The US has become increasingly unpredictable as a partner. The Paris Climate Accord withdrawal, then re-entry. The Iran nuclear deal negotiated, abandoned, then attempted again. The Abraham Accords pressed, then followed by inconsistent support for regional security. From Riyadh and Abu Dhabi's perspective, betting everything on one relationship looks riskier than it used to. Currency diversification is geopolitical diversification. It's insurance against a world where American priorities shift away from the Middle East. When the euro launched in 1999, many predicted it would challenge dollar dominance. It represented the combined economic might of what would become 27 nations, a market of 450 million people with GDP comparable to the United States. Yet 25 years later, the euro represents only about 20% of global reserves, stuck in roughly the same position it held a decade ago. What went wrong? The Eurozone's fundamental design flaw is well documented. Monetary union without fiscal union. Member states share a currency, but maintain separate budgets, separate bond markets, and separate debt obligations. During crises, Greece 2010, COVID 2020, the structure creates paralysis. The European Central Bank can't act with the speed and force of the Federal Reserve because it must navigate 27 different political constituencies. That structural uncertainty makes the euro less attractive as a reserve currency. China learned from Europe's mistakes. The yuan doesn't try to be a democratic currency serving multiple constituencies. It's an authoritarian currency serving strategic state objectives. That's not a moral judgment, it's a description of structure. The People's Bank of China can make decisive moves without legislative approval. It can deploy swap lines, adjust capital controls, or intervene in currency markets without the political theater that accompanies ECB decisions. But Asia's response to dollar dominance isn't just about the yuan. There's a broader trend toward local currency settlement within regional trade. The ASEAN nations increasingly settle trade in their own currencies, Thai baht, Malaysian ringgit, Indonesian rupiah, using bilateral agreements that bypass both dollars and yuan. Japan and India established rupee-yen settlement for bilateral trade. The Asian Clearing Union, established in 1975 but dormant for decades, has seen renewed activity since 2022. This matters because it suggests the future might not be bipolar, dollar versus yuan, but multipolar. Regional currencies for regional trade, with major currencies like the dollar, yuan, and euro serving different purposes in different contexts. That's a more complex system, but it's also more resilient. If one currency becomes unstable or politically weaponized, trade can flow through alternative channels. The lesson from China's rise isn't that every country should adopt the yuan. It's that dependence on any single currency creates vulnerability. The digital yuan, ECNY, represents something fundamentally different from both traditional currency and cryptocurrency. It's programmable money with full state visibility. Every transaction leaves a trace that flows back to the People's Bank of China. For a government that values social control, this is the perfect evolution of currency. But the international implications go beyond surveillance. China is already testing cross-border ECNY transactions through the Multiple CBDC Bridge project, mBridge, developed with the BIS Innovation Hub. The system connects central banks from China, Thailand, UAE, and Hong Kong, allowing instant settlement of cross-border transactions in digital currencies. The first live trades happened in 2023, mostly small-scale tests, but the technology works. And it's fast. Settlement in seconds, rather than the days required for traditional correspondent banking. For developing countries, this technology solves real problems. Traditional cross-border payments are expensive. Remittance fees often reach 6 to 7% of transaction value. They're slow, taking days to clear through multiple correspondent banks. And they're exclusive. Many smaller banks in developing countries lack direct access to dollar clearing systems. A digital currency system that offers instant low-cost settlement is genuinely attractive, regardless of surveillance concerns. Here's where it gets interesting for dollar dominance. Programmable currency can have automatic features built in. A yuan-denominated loan could automatically convert repayments. A trade contract could trigger payment upon shipment confirmation. These automations reduce friction in international commerce, making non-dollar trade more efficient. The dollar has always benefited from superior infrastructure, depth of financial markets, reliability of clearing systems, predictability of law. If competing systems become equally efficient technologically, that advantage erodes. Western nations are developing their own CBDCs, the digital euro, potential digital dollar projects, but they're moving slowly, constrained by privacy concerns and regulatory complexity. China's authoritarian system allows rapid implementation. That's creating a first-mover advantage in international CBDC infrastructure. By the time Western CBDCs launch, China's system might already be the global standard for digital cross-border settlement. Let's map the possible futures, because this isn't a story with one predetermined ending. The dollar won't collapse overnight, but it might stop being the only viable option for international trade. And that shift creates several plausible scenarios. Scenario 1. Managed transition. The dollar remains dominant but shares space with yuan, euro, and regional currencies. Global trade becomes genuinely multi-currency, with different currencies serving different purposes. Energy trades might increasingly settle in yuan. European internal trade stays in euros. Dollar dominance declines from 60% of reserves to perhaps 40-45% over the next decade. US interest rates rise slightly as Treasury demand softens, but nothing catastrophic. This is probably the most likely scenario. Gradual, managed, relatively stable. Scenario 2. Crisis-driven shift. A major geopolitical event, Taiwan conflict, major Middle East war, severe US domestic crisis, triggers sudden capital flight from dollar assets. Countries rush to diversify simultaneously, creating a disorderly transition. Dollar plunges, US interest rates spike, global trade disrupts as payment systems struggle with sudden reorientation. This scenario is lower probability but higher impact. The conditions exist, geopolitical tensions, high US debt levels, nervous markets, but require a specific trigger event. Scenario 3. Technological leapfrog CBDC infrastructure develops so efficiently that it makes traditional currency systems look obsolete. Countries adopt digital settlement systems that bypass legacy banking entirely. The dollar's advantage, depth of established financial markets, becomes irrelevant because the infrastructure itself changes. This is a longer-term scenario, perhaps 10-15 years out, but potentially the most transformative. Each scenario creates different second-order effects. In Scenario 1, the US sees modestly higher borrowing costs, but maintains enough reserve currency benefits to avoid crisis. American consumers might face slightly higher import prices. US companies lose some pricing power internationally, but it's manageable. In Scenario 2, effects are severe. Potential recession, financial market turmoil, possible emergency Fed interventions. Scenario 3 is hardest to predict because it involves technology that doesn't fully exist yet. For individuals and businesses, the implications vary. Companies with international operations need multi-currency strategies. Individuals with significant dollar savings might consider diversification, not out of panic, but as prudent risk management. Countries reconsidering their reserve positions need to balance liquidity, safety, and political risk. There aren't easy answers, but ignoring the question is increasingly imprudent. Here's what this all means. We're witnessing the slow-motion end of a financial system built in the 1940s. The Bretton Woods architecture, even after Nixon ended gold convertibility in 1971, rested on certain assumptions. American economic dominance, European Reconstruction dependence, Soviet isolation, oil denominated in dollars. None of those conditions still hold completely. China didn't trigger the end of the dollar era with a single action. It built the infrastructure for an alternative over 15 years. It learned from Soviet mistakes. You can't challenge dollar dominance with a closed capital account and non-convertible currency. It learned from European mistakes. You can't challenge with a currency area that lacks political coherence. The yuan strategy is different, controlled, gradual, backed by real infrastructure and actual trade relationships. But China isn't acting alone. Dozens of countries are making independent decisions that happen to align with Chinese infrastructure. Saudi Arabia accepting yuan isn't about allegiance to Beijing, it's about pragmatic diversification. France settling LNG in yuan isn't political positioning, it's about efficient trade execution. These countries are responding to changes in the global system that go beyond any single nation strategy. The question isn't whether the dollar will cease to exist or become worthless. It won't. The question is whether it remains the only realistic option for international trade and reserve holdings. And the answer increasingly looks like no. That no doesn't mean crisis. It means adjustment. The US will still have the world's deepest financial markets. Treasuries will still be seen as safe assets, but automatic, unquestioned dollar dominance is eroding. This matters for three reasons. First, it changes how US government debt works. Without automatic foreign demand for treasuries, the US might face higher borrowing costs. Second, it changes American geopolitical leverage. Financial sanctions become less powerful when alternative payment systems exist. Third, it changes how the global economy handles shocks. Instead of every crisis forcing capital into dollars, we might see capital dispersing across multiple safe havens. The next 5 years will clarify which scenario we're in. Watch UN settlement volumes in energy markets. Watch central bank reserve allocations and co-fair data. Watch development and deployment of CBDCs. Watch how quickly mBridge and similar systems scale. These indicators will show whether we're heading toward managed transition, potential crisis, or technological transformation. None of this is inevitable. The dollar has significant advantages: depth of markets, rule of law, established infrastructure, genuine economic productivity backing it. But advantages aren't guarantees. They're just better starting positions. And starting positions matter less when the game itself is changing. What's clear is that financial infrastructure has become geopolitical infrastructure. Countries understand this now in ways they didn't a decade ago. That understanding is changing behavior. And changing behavior, accumulated across dozens of countries and trillions in trade flows, changes the system itself. We're watching the architecture of global finance evolve in real time. Whether that evolution proves stabilizing or destabilizing remains the most important economic question of the next decade.